Right friends, welcome back to Banking Awareness. This is the 20th module. We are going to discuss the difference between banks and NBFCs and what is meant by a scheduled bank and what are the regulators for non-banking financial companies, what is meant by chit funds, nidhi companies, punji schemes and multi-level marketing. These are the things which we are going to discuss in this lecture, and let us look at the acts under which various banks function in this country. First and the foremost is the Companies Act of 1956, which was subsequently revised in 2013. Second one is the RBI Act of 1934, Banking Regulation Act of 1949, and at the same time various acts under which banks were nationalized. That is, SBI was nationalized in the year 1955 based on SBI Act of 1955. Similarly, 14 banks were nationalized in the year 1969 based on Nationalization Act of 1970, and 6 banks were nationalized in 1980 and one Nationalization Act is there that belongs to 1980. So, these are the acts under which various banks function in this country. And the second point I would like to tell you, banks will be categorized as scheduled banks as per Schedule 2 of Reserve Bank of India Act 1934, subject to certain criteria. Bank will be categorized as scheduled bank as per Schedule 2 of Reserve Bank of India Act 1934, and various categories are state cooperative banks, primary or urban cooperative banks, these two in cooperative banks category, then SBI, nationalized banks, private sector banks, foreign banks and rural banks. So, like this 7 categories are there, subject to certain criteria. These will take place as scheduled bank. We will come to this subsequently, and let us look at non-banking financial companies, various acts under which non-banking financial companies will function. Non-banking financial companies will function as per Companies Act of 1956, which was subsequently revised in 2013. Then RBI Act of 1934, remember only certain NBFCs are covered under Reserve Bank of India Act. That means RBI regulates only certain NBFCs, and for some NBFCs, the regulators are state governments, SEBI, IRDAI, like that various regulators are there for NBFCs. So, let us look into what is the difference between NBFCs and banks. Before going into it, what are the main activities of NBFCs? The main activities of NBFCs are business of loans and advances, then business of leasing, business of hire purchase, chit funds, like that the businesses which the NBFCs will undertake, they are almost similar to banks also. So, at the outset, let us define NBFCs. NBFCs basically deals with financial transactions. Please look into this slide. I have taken 3 NBFCs as example, out of which one NBFC is Manappuram Finance. If you want gold loan, you can go to bank or you can go to Manappuram Finance. Second one is the Bajaj Finserv Limited. If you want to take vehicle loan, you can go to State Bank of India or you can go to Bajaj Finserv. The third one I have given is the DHFL. If you want house loan, you can go to State Bank of India or you can go to DHFL. So, here what I mean to convey is this: non-banking financial companies undertake activities similar to banks. Whatever banks are doing, these non-banking financial companies are also doing. I have taken 3 examples. One is the Manappuram Finance for gold loans, then Bajaj Finserv for vehicle loans, then DHFL for house loans. But what are the primary differences? The similarities are many. Whatever banks are doing, NBFCs are also doing. So, similarities are many, but what are the main differences? If you want main differences, 3 main differences are there. please listen carefully. Three main differences are there. NBFCs cannot accept demand deposits. That means savings deposits, current deposits, these are demand deposits. These can be accepted only by banks but not by NBFCs. Demand deposits can be accepted only by banks, and as demand deposits can be accepted only by banks, banks can only give checkbooks. No NBFC can accept demand deposits and no NBFC can give checkbooks. That is the primary difference. And you may ask a pertinent question, can all the NBFCs accept fixed deposits? You may ask a question, you have told that they cannot accept demand deposits, but can all the NBFCs accept fixed deposits? Not all. To accept time deposits or fixed deposits, they have to take permission from their regulators. So, the blunt point which you should not forget is NBFCs are not allowed to accept demand deposits, and in case of time deposits, they can accept only with the permission from their regulators. Second important difference is NBFCs are not allowed under the payment and settlement system. You are doing transfer of money through RTGS, through NEFT, all these can be done only by banks. So, NBFCs are not allowed under payments and settlement system. Third important difference is deposit insurance facility under DICGC. You may ask, what is DICGC? DICGC is Deposit Insurance Credit Guarantee Corporation. Deposit insurance facility, all of you are well aware that if a bank collapses, you will be compensated up to maximum of rupees 1 lakh. That is DICGC. So, DICGC facility is only available for banks but not for NBFCs. So, these three are the major differences between banks and NBFCs. NBFCs undertake several activities similar to banks, but these three are the striking differences between banks and NBFCs. So, please don't forget. The most important point is banks are well regulated and NBFCs are not that regulated. That is the major problem, right? So, to have more clarity on banks and NBFCs, I have given in this PPT, please go through it. The bank is a financial institute which accepts different forms of deposits and lends them to the prospective borrowers and allows the depositors to withdraw money at any time they want. So, that is banking institution. And second one is NBFC is the financial institution, functions just like bank but cannot accept demand deposits and no facility of checks to withdraw money, right? So, these are the major differences between bank and NBFCs. By this time, I hope that you are clear about banks and NBFCs. Please look into this slide. Demand deposits and time deposits. Demand deposits, all the scheduled banks can collect demand deposits, but no NBFC can accept demand deposits. But when it comes to time deposits, all the scheduled banks can collect time deposits, and when it comes to NBFCs, only the NBFCs approved by RBI or other regulators can accept time deposits, all cannot accept. So, this slide is very clear, and please don't forget, demand deposits are savings deposits as well as current account deposits, and when it comes to time deposits, they are recurring deposits, fixed deposits and bulk deposits when you are looking at the banking system, right? So, banks in India, that is what is meant by scheduled bank. Often we hear about scheduled banks. Scheduled banks means subject to certain criteria. I am not going into the criteria. Subject to certain criteria, banks will be enlisted in Schedule 2 of Reserve Bank of India Act, and there are two categories in banks. One is the commercial banks, the other one is the cooperative banks. What is the main difference between commercial bank and cooperative bank? Commercial bank is profit is the motto, and the main theme of cooperative bank is mutual benefit. Cooperative banks are formed with minimum 10 shareholders. All the shareholders should get benefit, that is mutual benefit. That is the main theme of cooperative banking system. All should get benefit depending on their shares. But the motto of commercial bank is the profit is the only motto. So, commercial banks, there are 5 types which are enlisted in Schedule 2 of RBI Act. One is SBI and its associates, second is other nationalized banks, third is the regional rural banks, private sector banks and foreign banks. When it comes to cooperative banks, there are state cooperative banks and urban or primary cooperative banks, and with regard to these cooperative banks, we are going to discuss in 21st lecture. Please listen to 21st lecture. Right friends, now let us look at what are the NBFCs. So, we have so far discussed NBFCs will undertake activities almost similar to banks, but there are 3 differences, and now we are moving on further to bifurcate what are various types of NBFCs. First, look at NBFCs which are controlled by Reserve Bank of India. The regulator is Reserve Bank of India for some NBFCs, but not for all. And if you look at the NBFCs regulated by Reserve Bank of India, first is Asset Finance Company. If you want to purchase a tractor, if you want to purchase a car, if you want to purchase a truck, financing will be given either by bank or by some NBFC. All of you are well aware about Shriram Finance. You can go to Shriram Finance when you are purchasing a truck to get finance. So, these are called asset finance companies, and the regulator is Reserve Bank of India. Then infrastructure finance company, this is basically arranging loans for infrastructure sector. You may ask, what is infrastructure? Infrastructure is developing world-class highways, developing bullet trains, developing high-speed trains, developing world-class airports, so developing logistic hubs. So, these are all comes under infrastructure sector, and world-class infrastructure is essential for growth of any country, and India is in the process of developing world-class infrastructure. And here infrastructure finance companies, example is IDFC. Recently it got a license and established commercial banks also. So, IDFC, L&T Infra Finance, these are examples of infrastructure finance company. There is third category, infrastructure debt funds. This is to ensure long-term funds for infrastructure sector, and example is L&T Infra Debt Fund. I am not going into much detail about this. And the fourth one is the NBFC, MFIs. This is microfinance institutions, the institutions which give loans of small value in rural areas. They are non-banking financial company, microfinance institutions. Examples are SKS Microfinance, Ujjivan. So, they are working in the rural areas to ensure micro credit to the rural people. One more is NBFC Factors. A firm in Delhi sold some goods to a firm in Chennai. A firm in Delhi sold goods to a firm in Chennai, and taking the receivables from Chennai, including the risk, by a firm, that is known as factors, because the Delhi firm may not know about Chennai firm. That's why this NBFC Factors will take the responsibility of receiving money from Chennai, including the risk. They are known as NBFC Factors. Nowadays, several banks are into these factors. One is the Can Bank Factors, SBI Global Factors. So, these are examples of factors. So, these are non-banking financial companies factors. That means it assumes the risk of the receivables from a company. right? So these are the NBFCs controlled by Reserve Bank of India, and if you are looking at NBFCs not controlled by Reserve Bank of India, we have discussed about non-banking financial companies controlled by Reserve Bank of India. But if you look at the non-banking financial companies not controlled by Reserve Bank of India, please look into this. Chit funds are controlled by state governments. I would like to discuss some of them in this lecture itself. One is the chit funds, respect to state governments or the regulators. For insurance companies, the regulator is Insurance Regulatory Development Authority of India or IRDAI. For housing finance companies, the regulator is NHB, that is National Housing Bank, fully owned subsidiary of Reserve Bank of India, and it is headquartered in New Delhi. So please don't forget, if some non-banking financial company is giving house loan, the regulator for non-banking financial companies which are giving house loans is National Housing Bank, which is headquartered in New Delhi. Then stockbroking companies. Stockbroking companies, the regulator is SEBI because they comes under capital market operations. Then comes venture capital funds. Venture capital funds is the funds which are given to the startup companies, that is regulated by Securities and Exchange Board of India. Mutual funds, you may ask what is mutual fund? Mutual fund is pooling up money from several investors, pooling up a small value of money from several investors, and by applying their brain they invest in various companies. That is the meaning of mutual funds. And mutual funds regulator is Securities and Exchange Board of India. Then comes one type of companies, that is the Nidhi companies. The regulator for Nidhi companies is Ministry of Corporate Affairs, Government of India. We are going to discuss what is Nidhi company. Then multi-level marketing. Multi-level marketing comes under the regulatory purview of state governments. Then collective investment schemes. What is meant by collective investment schemes? Collective investment schemes are the schemes where the company will collect money from public and they offer exorbitant returns. So the regulator, when the collective investment schemes value is 100 crores or more, is SEBI. Then future commodity trades, future commodity markets. Previously Forward Markets Commission was the regulator, but now it was merged with SEBI. That's why for future commodity trades, the regulator is the Securities and Exchange Board of India. And please don't forget, when the operation is concerning capital market, the regulator is the Securities and Exchange Board of India. When it concerns housing finance, the regulation is with the National Housing Bank. When it concerns insurance business, the regulator is IRDAI. When it comes to chit funds or multi-level marketing, the regulator is respective state governments. So these are various non-banking financial companies and the regulators as I have listed here. And for non-banking financial companies where RBI is the regulator, we have already discussed in previous slides. And another two terms I would like to tell you. One is RNBCs. In addition to NBFCs, there is one category of firms known as residuary non-banking companies. Nowadays, RBI is not giving any license to these types of companies. Normally, when non-banking finance companies collect money, the main purpose is to undertake some leasing or hire purchase or giving loans. But these RNBCs will collect money, but they do not undertake any asset financing, loans or investments. The licenses were given long back and most of their assets will be in the liquid form and governed by special instructions from Reserve Bank of India. And examples are Sahara India Parivar and Peerless. And for these type of companies nowadays, Reserve Bank of India is not giving any license. And unincorporated bodies are the loose entities. They are not companies literally. Unincorporated bodies are basically not regulated entities. They are loose firms. Right? So, this is various terminology, and before winding up, let us discuss some terms. One is chit funds. All of you are well aware about chit funds. This is based on Chit Funds Act of 1982. As per this act, state governments are authorized to issue guidelines and hence state governments regulate them. In some countries they are called rotating savings and credit associations, and in India, in some states they are called chit, chitti, kuri, like that. And there is no standard form of working, and here periodic subscriptions are made by the members, and among the members there will be one beneficiary every month or at the agreed period. People will contribute the amount, and every month or at agreed period there will be one beneficiary is among the group of members, but they are poorly regulated and several instances of failures. Nidhi companies, they are basically in southern part of the country, especially in Tamil Nadu, and they are regulated by Ministry of Corporate Affairs, Government of India, and basically they collect money from their members and they can give loans only to the members. They can collect money from the members and they can give loans only to the members. So, these are Nidhi companies. They are based on Companies Act of 1956, subsequently revised in 2013. Look at the next one, Ponzi schemes. Sometimes you will get advertisements that if you invest 1 lakh rupees, you will get 2 lakhs after 1 year. These are called Ponzi schemes. They offer exorbitant returns. For few customers initially they will pay, but when the business increases exponentially, one fine morning they will abscond. They will offer exorbitant returns, but one fine morning they will abscond. These are Ponzi schemes and now controlled by Securities and Exchange Board of India, but there are several grey areas. That's why these are not able to be controlled either by SEBI or by state governments. Exactly what falls under collective investment schemes, what falls under Ponzi schemes, there is not much dividing line, and sometimes they are not known to SEBI also, and as such most of the times the investors lose money in these Ponzi schemes. They promise exorbitant returns of 50% or 100%, and this name became familiar with the name of Charles Ponzi of Italy. Look at the last one, multi-level marketing. Multi-level marketing are known as pyramid schemes or network marketing. One example is Amway. Here, if you are a member of Amway, you are required to nominate 3 or 4 members, and again each member is required to nominate 3 or 4 members. But if a person sells the product, then everyone up to the top will get commission. This is called multi-level marketing, and these are controlled by state governments. And multi-level marketing, the price of the products is exorbitantly high because commissions are to be given at each and every level. So, this multi-level marketing is controlled by state governments. So, we discussed about various non-banking financial companies, and the last word is banking system is absolutely safe because of its stringent regulation by Reserve Bank of India. But non-banking financial companies are poorly regulated, and several times the regulators may not know about the existence, especially with regard to these collective investment schemes. That's why your money in the banking system will always be safe. Right friends, please do join for 21st module. We are going to discuss cooperative banks in 21st module. Have a nice day. Thank you.